Okay, I hope you enjoyed your lunch. We're now going to continue with the conference. Finance is available to Greek shipping now in 2024 from lots and lots of sources. And we're going to have two sessions, one with owners and one with financiers. The first session is owners discuss the best finance options, and our moderator is Peter Theochari, partner in the Maritime Trade and Offshore Group of Stevenson Harwood. Peter, please.
Thank you very much. I know this is what you all wanted after lunch, so please stick with us. We've got a very, very interesting topic today. It's, as Kevin just said, owners discuss best financial options, and it's so broad. We'll do what we can in the next half an hour or so. But keeping in mind what a lot of the other great panels earlier said, we're in this current climate of incredible strength in the shipping markets, and that makes financing options that little bit more interesting because, and the giveaways in the question, it's not just about what options are on offer, but what are the best financing options for owners? How are they supporting their growth in these almost unprecedented times? So we've got a really experienced and varied panel to help us answer these questions. We've got Alexis Stefanou, CFO of Goldenport, Christopher Thomas, CFO of TC Holdings, Robert Perry, CEO of Ocean Power Inc., Thomas Lister, CEO of Global Ship Lease Inc., and Yanis Koukoulis, Vice President of Purchase at SPM Shipping. So I think let's get straight into it, and if I can start with a very general question. So owner to owner, lots of different financial priorities, capital structures, risk appetite, and so on. In this low margin environment, what are your fundamental requirements from your debt providers of any kind? Or to put that another way, how do you pick your finance partners? Alexis, would you like to kick us off?
Sure, and many thanks to Marine Money for the invite. Look, the low margin environment, I think, does not fundamentally change the way you, or at least we, approach the financing community at large. I think what has really made a difference is several years of very strong profitability and cash flow generation that has enabled us to repay a very large chunk of our indebtedness. In terms of the way we work with banks, we have a group of relationship banks we work with. And in this low margin environment, I think certainly that helps in terms of the interest cost attached to our facilities. And when we seek new facilities, for example, when we have a new building project, what we aim for is to have conservative leverage and a low cash break even. So certainly the low margin helps in that regard. The other component being we want to see an attractive loan profile. So 18 years for a new building is something that I think we have has become a little bit the standard in our industry nowadays.
Anyone else would like to add to that, offer a different perspective maybe?
Shall I have a crack at that?
Sure.
All right. So first of all, 10 seconds on Global Ship Lease, just so you know the context within which most of these comments are being made, at least by me. So we own a fleet of 68 container ships. We're listed on the New York Stock Exchange and have been listed since 2008. And all of our ships are time chartered out to leading liner operators. So there's, the perspective from which I'm coming. Now, I would echo pretty much everything that's already been said, but I would also make the point that we're all operating within a highly cyclical industry. Now, cyclicality is both the blessing and the curse of shipping. And I was looking into to our numbers, our total shareholder return numbers, in preparation for this panel. And to give you an idea of the upside in numbers, over the last 5 years, we have generated total shareholder returns of roughly 350%. Great. That's roughly 3 times the S&P 500. So this is one of the reasons to actually go into shipping. And if you're an investor who comes in at exactly the right point in the cycle, so at the very bottom of the cycle, and gets out at the very top, total shareholder returns in that instance would have been about 1,300%. Now, the reason I mention this is because access to capital really only makes most sense if you can tap it at the bottom of the cycle when interesting investment opportunities are available. So I would say our approach to debt is doing what we can to diversify our sources of capital to ensure that it's available when we need it. Very few of us, I think, need capital now, but when we need it is when it's most difficult to tap it. So we have strong relationships with banks, hopefully, that will support us through the cycle. We've tapped the US private placement market, so private debt, to have an additional source of capital available. We've tried the public debt markets in the past, and the list goes on. So essentially, we're doing all we can now to lay the groundwork to be able to tap the capital markets, the debt capital markets, in due course when we actually need to and when there are investments available. And that doesn't really change, I would say, in a low interest rate environment, which is where we are at the moment.
That's very interesting. We're going to touch on other ways of raising capital shortly. Anyone else want to add anything to that, a different counterpoint? Yanis?
Sure. Okay, so firstly, so as to understand why we want these requirements for our finance, we have to understand our profile. SPM Shipping, we own now 17 vessels. We are quite a young company, so we're in a growth mode, let's say. In this regard, we mainly focus on the leverage we can obtain and also on the hidden fees. We want to avoid hidden fees from our financiers. This has to do with the fact that if the market goes down or in a bad market generally, we want to avoid any traps in getting ruined, let's say. Now about the leverage, obviously, we want to obtain another 20 vessels, as we have in plan, over the next few years. So obviously, getting good leverage is something very important for us at the moment. So this is what more or less we are seeking for from our financiers right now.
Yeah, thank you. So I think with those fundamentals in mind, there's a question about whether actually your requirements are more easily satisfied by non-bank debt and, the rise of non-bank debt. Do you still think, as a group, there's a role for non-bank debt, bank debt, a combination of both? How do you feel about that? Or are, the requirements of some banks at the moment just too onerous with, cash management services, hedging, and so on?
Sure. I mean, bank debt is something of our interest. There is one issue, though, that the best banks to get finance these days are the Greek banks for shipping. And we're not a Greek company, so we do not have access to that, apparently, regardless of our good financial status and all this stuff. Anyway, so we do not have access to that. We do have access, though, to some good banks in the UAE and in India. The thing is that we are not getting the leverage we wish to get from the banks. So right now, we're also working on other structures like BBHP. We are also doing funds. We do not work that much with funds because they are quite expensive. We do generally quite a lot of Chinese leasing houses. This is what we like to do. We have very good relationship with the Chinese and also with the Japanese, so we get mostly what we want at the present situation from those two regions. But of course, for sure, there is interest and there is a proper moment for a regular bank's finance.
Thanks. Any other views on that? Rob? Yep.
There we go. I mean, the reality is the larger companies, as Thomas mentioned, they can choose all the different types of financing they want from the banks, from the different markets, from things like this. Some of the smaller owners, it becomes much more difficult because they don't have the capacity to go to all these different places. And what we've seen in the past is the relationship banks, as much as we like them and as good as we feel with the relationships, they go away. People leave, the banks get bought, the banks get sold, they sell off their portfolios, even banks that have been in shipping forever. So the relationship banks are a bit tougher sometimes. But at the same time, you want to have access to the Chinese leasing or to the JOLCOs or to the private equity markets or to the other markets. So it's hard to try and balance where you're going to get your capital from at the end of the day, because when the market turns, and we're in a very good market now, and you were joking about it, but it's true that now every bank wants to lend. The Greek banks are super competitive, and they're putting a lot of pressure on all the other banks to lend to places where they don't typically want to lend, but they have to because there's just not enough growth in the market. But when the market turns bad, they're not there anymore. And then everyone's going to have issues trying to find, financing if they went away from their banks that know them the best, that they don't do all the other services with.
Yeah, definitely. I mean, the kind of availability of Greek debt at the moment is, everybody's very aware of that. But I think let's drill down on that a bit more then, particularly these alternative methods of financing. So it's no secret the market's very diverse, whether that's ECA backing, structured products like JOLCOs, Chinese leasing money, private credit, private equity, and so on. But I think to answer that question properly, what's on offer and what are you doing, we need to know where this has come from. Why is it now so diverse, and why now in particular are there all these options? And I think, Chris, some of the discussions we've had, I think you might be very well placed to have a go at this one.
Thanks, Peter. Yeah, first of all, thank you to Nick Sakos for the wine. It's certainly going to make my presentation a lot slicker. So, yeah, let's go back a bit. Let's split it into sort of new buildings and second-hand. New buildings, the finance follows wherever you're building. So even if you go back to the 70s, where UK was building 25% of the world's fleet, financing was coming out of London. That shift down to Japan, you had the trading houses move to Korea, you had KEPS, etc. And now, of course, China. How that's developed over the last decade or so in terms of the ships they're building. It was bulk carriers. Now they're building such sophisticated vessels as LNGs, VLCCs, super containers, etc. So you have, as we see here with a couple of sponsors, you have the leasing. So from that point of view, the finance, as a CFO, you're driven, where you're basically building the ships, I think. In terms of second-hand, it's interesting what Alexis said about relationships and what Rob said. Yeah, I considered relationship banks very important during my early career, but they go. The options you have available today are so diverse. I think as a developing company, like Jan is here, those options are not widely open to you. But when you get to the size of Thomas's company here, I think you've got to look more to what your business model is. And I think a lot of the larger companies now, Thomas was talking about, the time charter coverage. Do you need to be an owner of vessels? Are you more an industrial shipper now as opposed to an asset player? So I think as a CFO, you've got to look very much at how you're going to structure your balance sheet. Do you want those assets? Now, I appreciate the leasing now. The accounting treatment for leasing has changed considerably. So you have all those liabilities on the balance sheet, but you're still able to create some synthetic EBITDA through leasing transactions. So I think it's diverse for the larger owners, and I think the CFOs of today have got a bigger task. If they have debt, I mean, there weren't many ship owners on these panels that have debt, but in normal circumstances, I think you've got to look very closely at the balance sheet and whether you want to be asset heavy, asset light, and what your business model looks like. So I think for the larger owners, you've got to look at what your business model is.
Yeah, just to add to that, I mean, as an owner, we are by definition asset heavy. That's our business, and this is a capital intensive industry. So I think the way we look at it is just maximizing optionality through the cycle. We just to sort of give you a sense of our story, we listed on the New York Stock Exchange about 3 weeks before Lehman Brothers went bust and the world changed, and the worst decade the container shipping industry has ever lived through commenced. And during that time, we started off with plain vanilla debt from lending banks. And as things got worse and worse, banks began to sell that debt down to vulture funds, and things began to get very hairy indeed for people in the space. So I think the lesson of optionality and not relying upon a single source or flavor of capital through the cycle was made very clearly, at least to us, pretty much from the get-go. So optionality is everything in our view.
Perhaps if I may add on to that, and linked also to Chris's point, of course, what we have been seeing in the last decade is a shift in financing from Europe to the Far East, and very much so in the context of our new building projects. We have worked both with leading Chinese and Japanese lessors, diversifying our funding sources in that sense. What we do find, however, is that the appetite of the Far Eastern lenders is often, for high leverage transactions that do not necessarily correspond to our more conservative risk profile. So what we have endeavored to do is do 60 or 70% LTV maximum, but to try to get the lowest margin that we can negotiate with them. So and obviously the profile, as I referred to earlier, the longer profile. So definitely there is a shift that is happening, and it's obvious that the companies need also to adapt themselves. They cannot just rely on the local or the European banks. They need to look to the east as that market is fast growing.
And to round that point off, I mean, Yanis, you mentioned earlier Chinese leasing houses and the interest that you have in those sorts of financing structures. I mean, you've heard what the other panelists have to say on that. What is it you're exploring with them in particular then? What other things are you looking at?
No, it's mainly actually through their various structures, we managed to obtain very good interest rates, which is not really possible through the usual funds from the United States or from other regions. So this is how we try to do it. Sometimes it's on a bareboat structure, sometimes it's in a way of a mortgage, but this is how we try to do it, and this is what has been proven as the most effective for us. This is only though for our tankers and the cape sizes we have, for the dry vessels we have, because for the offshore units it's not that easy. For the offshore units, we have realized that unless there is a specific project, we cannot find some competitive finance structure regardless of the region. So we use our own equity for those ones, and we just try to see once we have a specific project, like an Indian governmental project, we obtain finance from there. This is quite easier and cheaper, because, to be honest, it's quite easy to find finance. The problem is to find the finance you need for each specific project.
Yeah, and that's what this is about, best options, not just any option.
Peter, can I add to that? Because I don't know enough about the fleet profiles of everyone else sitting up here, but we've got quite an old fleet, which is by design rather than by accident. But what that means is that certainly for some of our older ships, finding capital, debt capital, plain vanilla debt capital is not so easy. And that's prompted us to, I mentioned this in the sort of the opening remarks, that's prompted us to establish a foothold within the US private placement market, where there are lenders, private lenders, who are more interested in cash flows than they are necessarily in the nature of the collateralized asset. So that's certainly something that we've found very useful as an additional source of capital, and it's one which is growing very, very fast. I don't know the exact numbers, but I know that it's over $1 trillion in terms of a capital pocket that's available to dip into. However, you do need to be rated in order to tap that market. So we, at the corporate level, are rated BB+ by S&P and Kroll, and Ba2 by Moody's, and the actual paper that we placed into the US placement market was rated investment grade. So that's another string that's available, but you do have to be perhaps of a particular size as a company to tap it.
And I think that's actually a very nice segue into really the next question, which is about availability, fleet profiles, new builds, old builds, and so on. So, you will, of course, use different types of financing for different types of vessels, and depending on whether they're new or second-hand. But to build on that, and I'm just conscious of time as well, the rise of green shipping, green ship finance, and so on, is adding another dimension to that and this availability of financing. You know, for example, what are you seeing when it comes to new builds versus old builds and the financing on offer when you take into account that some banks have got now very, very stringent requirements on what their investments have to look like from a green perspective?
Well, let me start off then on that. One of my previous roles was with ADNOC, the national company. We had a very, very wealthy parent, so there's very little in terms of debt that we needed. However, we did a joint venture with a Chinese partner who was shipping LPG. And for ADNOC, the green credentials from banks was very, very important, actually. Given it's a national oil company, given environmental damage, etc., that they were inflicting in the Gulf, it was very important. So we could only select from a panel of banks those that had signed up to the Poseidon Principles. So that's just one detailed case study that I had. I'm not sure how important that is, and I don't have the experience on, you know, the Chinese guys and leasings, whether they've adopted the Poseidon Principles or not, and it'd be interesting from the other guys to see where, in terms of priority, where does that come?
Okay, so we've looked at various sort of sustainable bond financings, and as far as we can tell, financing on a quote-unquote green basis, on a sustainably linked basis, is only going to get you in an improvement in the margin of roughly 25 basis points. So you're not going to get substantially better pricing by financing on a green basis. However, I would say more broadly, even financing on what is not officially a green basis, lenders, as Christopher was saying, tend to be increasingly signed up to the Poseidon Principles, and they want to see that the borrower has a credible decarbonization strategy that they're actually putting into effect. So I think whether or not you're borrowing on a green basis, quote unquote, you still need to be presenting evidence that you're decarbonizing your fleet in order that the lender can continue to decarbonize their portfolio. I don't know if that sort of addresses your question, Christopher.
Well, if I was to add a slightly different take on this, what I fully agree with Tom's statement regarding, you know, the benefit, so to say, of in terms of the cost is not very significant, not material. But what I have seen, we have not really experienced it ourselves because we have, you know, our older vessels are all debt-free. But what I have experienced is that the banks that have signed up to the Poseidon Principles are actually not interested in financing or refinancing the older second-hand vessels. So you take them a 10-year-old vessel to be refinanced. They would much rather do a new building or a 5-year-old vessel, because at the end of the year, you will be sending them the IMO DCS data of the vessels that they are financing, and they will be pulling all the data together, and then they will come out with the statistics as to what is the progress that has been made on their portfolio as far as the compliance with the targeted, so to say, roadmap according to the Poseidon Principles is. So in that regard, they would match the signatories of the Poseidon Principles are much more interested in financing the modern eco vessels rather than a second-hand, 10 or 15-year-old vessel.
No, all I was going to add is what Alexis just said is that, like the large multinationals are great to go to for brand new vessels or for less than 5 years old. Anything else, it's when you start looking at alternative financing, you go to the mid-tier banks, you go to the Greek banks, the Taiwanese banks these days, or the Chinese banks, which are there to do this type of stuff. And they don't really care as much about green financing as the other guys. Just my 2 cents.
Thank you. So if we come back to kind of a more general level again, as owners, over the next couple of years, what do you think are the main, or just pick one headwind, one tailwind that you've got to contend with?
I'm not quite sure if it's headwinds or tailwinds, Peter, but we're back in 2007. You know, there was such an abundance of money being thrown at CFOs at that time. And I think we've got that today. The options available to everyone on this panel and outside too is enormous. And it seems to always come back to pricing. That's what I've heard mostly today. It's pricing first, structure second. I kind of looked at it a bit different because I didn't want to keep refinancing ships every 5 years or so. But it is, we're back to 2000s. There's such an abundance for those that need it, which is very, very few on this day. It should be a joy for CFOs. Isn't that right?
Yeah, I mean, to that point, I agree that there's a lot of money out there. I mean, again, I might be the only one on the panel as an older fleet than you. And people are chasing me for, scrap finance and things like that, things that I would never think people would lend money to for us. They want to come and lend to us. We're not interested because we want to keep our break even low, but eventually it stops, right? And then those guys, it dries up, and it dries up usually quickly. I mean, the capital markets panel was talking about taking the money when you can get it, which is also true on the banking side to an extent. But then again, you run into a lot of issues with the banks when times are bad if you take money when the market's too hot. So it's a bit of a give and take. And one other thing, if I may, on the tailwind side that people are looking at is that rates are coming down, and all of a sudden, with the low margins, you're getting lower, let's say, SOFR, or you're getting lower Euribor, and that looks good. But usually when the margins are coming down, that's when the banks start running into more trouble. So you got to be very careful there, just from my point of view.
I don't know if this is a headwind or a tailwind or just a fact of life, but I think it's going back to one of my opening remarks, which is we're in a super cyclical industry, and classically, when the skies are clear and you're at the top of the cycle, everyone wants to give you an umbrella. And as soon as it starts to rain heavily, people want the umbrella back. So I think, the mismatch between the capital markets cycle and the availability of capital when you don't need it versus the down cycle in asset values where there are actually interesting acquisitions and value accretive acquisitions to be built, to be made, that's the fact of life that we're all having to wrestle with. You have money when you don't need it, and it dries up when you want it. So you've got to try to build your balance sheet and your accesses to, or your access to different sources of capital to try to bring you through that cycle. So maximize optionality again.
Perhaps just very briefly, in terms of the tailwinds, I agree with Rob's earlier point about the expected decline in interest rates. That's certainly a positive, from the borrower's point of view. The headwinds that I can see, but it's still a bit further ahead of us, but and perhaps even to your earlier point, Peter, about the difference between banks and non-banks, is the increasing regulatory burden, and specifically, I think, in terms of the financing costs, the adoption of Basel IV, which has a different timeline in different jurisdictions. So that is going to be, I think, represent headwinds for our financings.
Okay, so I heard Rob mentioning scrap finance, and it came to my mind one specific point, one concern we have actually for the future, for our projects, for everything. When we see a vessel in the market and we say, this vessel suits our profile, we start running all these Excel sheets. We give them to all our departments to take their inputs and stuff. And, at the end, we have this residual value which is quite high right now because scrap prices are very high historically. The problem is that the values also are quite high, but on our Excel sheet, at least they make sense. The problem is, will they make sense in a couple of years when the scrap value of the vessel will be much lower than that? This is our main concern and, you know, what makes us feel not that confident, let's say.
All very, very good points. And oh, perfect. Quick fire finisher. Each of you, please. What's your next deal and how are you going to finance it? If you can tell us.
I can. I have no idea at all. That's true, to be honest. We have no idea. We're looking on various projects, but right now it's not like we see something specific that, you know, it's of our great interest.
Likewise, I don't know, next acquisition? Well, I'm retiring soon, so I've reached the retirement age, so perhaps a Ferrari, Peter, will be the next acquisition, or some midlife, you know, two-seater soft top.
Let me know if you need finance on that. You, Rob?
I think I saw my legal counsel in the room, so I refrain from answering that question at the moment.
Yeah, I'm afraid I can't make it any more interesting either. We'll see.
Well, from my perspective, Golden Port, as most of you know, is a well-diversified group across dry bulk tankers, product tankers, container ships, and LPG. What we have been working on for some time now is an expansion into the offshore support vessels sector. And that is a transaction that is in the Middle East. We have been working on this together with a very strong financial partner and also an experienced operator in the region. So in terms of the financing, that is going to be a financing that is going to be also done locally there in the region. So I think that's, again, there is a geographical element, I think, to the choice of financings that people do. I think also one of my panelists, co-panelists referred to the Greek banks' interest in working and supporting the Greek shipping community. They have known the companies for many decades, the people, the families behind them, and we are, you know, very appreciative of their support in that regard as well. But for every deal, I think there are horses for courses, as they say. So, thank you.
Brilliant. Thanks very much.